Picture this, a shiny new tech company bursting onto the scene. Their initial public offering, or IPO, is met with a media frenzy. As an investor, you're drawn to the allure, the promise of ground floor access to what could be the next big thing. But amidst this whirlwind of hype and speculation, something you heard from Warren Buffett echoes in the very back of your mind. An IPO is like a negotiated transaction. The seller chooses when to come public, and it's unlikely to be a time that's favorable to you. It's akin to waking up from a dream where you're about to take a bite of the most delectable, sweetest chocolate cake, only to realize that the cake, well, it's not for you. It's for the company going public. They've whipped up this confection at a time that's most savory for them, not necessarily for your investment portfolio. And here's why. Companies choose to go public when the stars align in their favor. That might mean market conditions are just right. Their corporate narrative has piqued investor interest, or perhaps they've achieved a milestone that makes their shares irresistibly appetizing, meaning that initial valuations can be overblown due to surrounding hype or expectations. And in the long run, it's better to wait for realistic and favorable prices. But fear not, dear listener, this isn't a tale of doom and gloom. Far from it. It's simply a reminder to tread carefully, to not let the sparkle of a fresh IPO blind you from making a sound investment decision, which comes from careful analysis of the company. So the next time you hear the siren song of an IPO, remember our friend Buffett's wise words. Take a pause, do your research, and don't get swept up in the tidal wave of initial public hype. Because as exciting as it is to be a part of something new, it's even more rewarding to be a part of something profitable.